One of the most important concepts in structured commercial finance is understanding the blended cost of capital. When evaluating multiple financing proposals, borrowers and originators should not focus solely on the quoted interest rate of the senior loan. The real analysis involves understanding the weighted cost of all layers within the capital stack. This becomes especially important when comparing senior plus mezzanine structures, senior plus preferred equity structures, and higher leverage stretch senior executions. Example: senior plus mezzanine structure. Assume the following transaction. Total project cost, $25 million senior loan, $17 million at 6.50% mezzanine loan, $4 million at 12.00% total debt, $21 million at 84% Lieutenant Colonel. The blended cost calculation works in two steps. Step 1. Calculate the weighted interest for each tranche. Senior, $17 million by 6.50% equals $1,105,000. Mezzanine, $4 million by 12.00% equals $480,000. Total annual interest, $1,585,000. Step 2. Divide total annual interest by total debt. $1,585,000 per $21 million equals 7.55% blended cost of capital. Why this matters: compare that structure to a competing stretch senior proposal. Structure: leverage blended rate senior plus mezzanine 84% LTC 7.55%, stretch senior 80% LTC 8.50%. In this scenario, the structured execution delivers 4 additional points of leverage at a blended rate nearly a full point lower than the stretch senior alternative. Less required equity, better proceeds, lower blended cost. That is why experienced originators do not simply compare note rates. They evaluate the entire capitalization strategy. Note: leverage thresholds vary by asset class, market, and lender appetite. The figures above are illustrative. Senior lenders commonly cap at 65 to 70% Lieutenant Colonel, and mezzanine attachment and detachment points are deal-specific. What originators need to account for fees and loan economics. Interest rate alone does not tell the full story. A lower rate does not always mean a lower effective cost of capital. Before drawing any conclusions about which structure is cheaper, originators need to account for origination fees, exit fees, prepayment penalties, extension options, legal costs, reserve requirements, earn-outs, and rate lock costs. Timing of funding. The blended rate calculation assumes both loans fund fully at closing. In construction or transitional lending, that assumption often does not hold. Mezzanine financing may fund first or remain outstanding longer than the senior facility, which means the more expensive debt is on the books longer than the model assumes. In those situations, simple blended calculations can materially understate true capital costs. Blended cost versus WACC. These terms are often used interchangeably, but they measure different things. Blended cost of capital refers to the weighted cost of the debt stack only. Weighted average cost of capital incorporates debt costs, equity costs, and sponsor return expectations together. WACC is the more common framework in institutional and private equity analysis. For most deals you will close, blended cost of debt is the number that matters. When a structured stack is not the right answer, layered financing is not always the best solution. Adding a mezzanine tranche introduces a second lender, a more complex intercreditor agreement, additional legal costs, and longer closing timelines. For a borrower who needs to close quickly, values a clean capital structure, or is working with a lender offering competitive all-in pricing at sufficient leverage, a single loan execution may be the stronger choice. The goal is to match the capital structure to the deal, not to add complexity for its own sake. What sophisticated originators know: the cheapest loan is not always the best loan. Higher leverage can improve investor returns even when it carries a higher blended cost, because the additional proceeds may reduce the equity requirement enough to move the overall return on equity. Flexibility in the form of extension options, earn-outs, or staged funding can be worth more than a lower rate in transitional or development situations where timing is uncertain. And the structure of the capital stack has a direct impact on exit strategy and refinance risk, factors that matter as much at loan maturity as they do at origination. That is why commercial lending is ultimately a structuring business, not simply a rate business. The ability to analyze and explain capital stack alternatives, including knowing when a simpler structure is the right answer, is one of the clearest differences between a transactional broker and a true commercial advisor.